The first situation where we might need to use the general journal is when the owner commences a new business. So, for example, let's say the owner gave the business to begin a cash contribution of 60 grand, a vehicle which cost 50 and had an agreed value of 40, equipment of 5,000 and a loan of 18,000 which was taken out against the vehicle. So it's important to note that the owner can give the business liabilities as well as assets. So in this case, a loan of 18,000. First of all, let's deal with the agreed value of 40,000. What does that actually mean? So the agreed value is an estimate by an independent party of the current market value of a second-hand asset that the owner contributes to the business. So it can be hard to get a value of something we're giving second-hand to a business. So we go and get an estimate by a party who's independent of its current market value. So in this case, we've got a vehicle of 50, the cost was 50 when the owner bought it. It's now got an agreed value of 40. Which figure do we use? Well, the study design says when the owner contributes a non-current asset, the valuation of assets will not be based on what the owner originally paid, but on the agreed value at the time the asset is contributed to the business. So that's straight from the study design. So why are we using agreed value? Well, it comes down to relevance. So information is relevant if it influences our decision making. So the agreed value is a relevant figure because it's the best estimate of the current market value. That'll help us make decisions. So for instance, how much should we insure the asset for? How many future economic benefits has it got for depreciation purposes? And how much the asset could be sold for in the future. What about agreed value and reliability though? Reliability says no opinions or estimates and we need source documents to verify it. Well, we could argue that this is not a reliable figure. It's basically an estimate of current market value. It's subject to a personal opinion and there's no reliable source document. We might be able to get one from a valuer, but it's just a document which is proof of someone's opinion. So this totally breaches reliability. So back to our question, we know we're going to use the agreed value of 40. So let's look at the items we're giving the business. We've got an asset called cash, an asset of a vehicle for 40 grand, $5,000 of equipment, which is an asset, and a loan of 18,000. So how will these get from the business to the firm's general ledger? So looking at the special journals, they simply aren't suited for all these items. So we've got one item here. If the owner's going to give the business cash to start a new firm, that could go in the cash receipts journal. So that's an easy one. So that'll just go in through the cash receipts journal. But looking at the vehicle, the equipment and the loan, it's just doesn't fit neatly into any of the other journals. So what we're going to have to do instead is use the general journal. So what's that going to look like? Well, very easy. We're just going to put, first of all, the cash in the cash receipts journal. We'll put the date, the actual date. Right, the details is capital. Receipt number, which will be given to us. The bank will go up 60 grand, and then we'll put that in the sundries column. Looking at the vehicle, the equipment and the loan, that'll go in the general journal. So we use our date as the 11th. We'll do a debit to vehicles in the general ledger, a debit to equipment of 5,000, and we'll have a loan going up 18,000, which is a credit. However, our debits don't equal our credits, so what we've got here is the owner contributing capital, but also contributing a loan. So the difference here will be capital of $27,000. Put a narration in, so in this case the owner contributed assets and liabilities to commence the firm, and then I guess we're just going to go, well, where did the $27,000 come from? So looking at that, we always know capital or owner's equity is going to be equal to assets less liabilities. So in this case, we have total assets of 45 grand, which were the vehicle and the equipment, less away the liabilities of 18, which was a total of 27,000. Posting now to the ledgers, we've got a bank column of $60,000. That'll make cash at bank go up, like so. And the capital column in sundries, that'll make capital increase, like so. And the two accounts will reference each other. Looking at the dates, journals are always the actual day of the transaction, but the general ledger will always be the last day of the period. The general journal, we've got a debit to vehicle, so that'll be an asset going up. We've got equipment, which is an asset. Excuse the typo, it says equipment is an expense, equipment's an asset, so that'll go up as a debit. We've got loan going up, which is a credit because it's a liability. And lastly, we had owner's equity or capital going up. So first of all, we've got the $18,000 loan going in as a debit, but we've also got the $40,000 vehicle going in as a credit and the $5,000 of equipment as a credit. So all up, the total there will be $27,000. General journal, we use the actual date, and then in the general ledger, we always use the last day of the period.